Welcome to The Subject Property. I'm Stephen Harrison, Joint Managing Director of Ray White Commercial WA, and I'm here with Grant Priest, Director of UHY Haines Norton, Perth. And just on Tuesday night, there were a number of changes to trust structures announced in the federal budget, and we're here to talk to Grant about that as our commercial property tax expert. Grant, probably first question that I have, first and foremost, like with these changes, should investors be changing out of their trust structures?
Steve, thanks for having me today. No. Simple question. Every decision's got some makeup on detail.
Yes.
And as a general rule, the shifting out of a trust, if you're planning on hanging onto the property longer term, is not a good idea.
Right. Okay. Well, let's take it back a touch. So, look, just briefly, because I'm sure most of our audience are already aware, what were the changes that were announced on Tuesday night?
Right. There was two levels of changes. One was the taxing of income in a trust, and the second was the capital gains that emanate out of a trust. For income, the trust now will be paying a minimum tax of 30%, and the trust will actually be paying the tax on the income before they leave the trust. So very similar to companies. Only difference is we don't get credits for that tax or creditable. They're in the hands of a beneficiary. So Dad gets a $10 distribution. He'll get $7. $3 will be tax. If his tax bill is $20, or no refund, like you do with franking credits.
Yes.
It's lost.
Right.
And that's where the damage is.
That's where it hurts.
Yeah, on the income. So from a commercial property investor, that's your rent. So
yes.
that's going to be the leakage on your income or your rent.
Why precisely would you not recommend shifting out of the trust structure?
Well, trusts aren't just there for tax management. Trusts actually have quite a significant structural purpose in a person's investment life. Generally, if someone's got a trust, they've got fairly significant assets or sufficient assets that one's worried about losing them if they have a mistake in life. Typically doctors, surgeons, solicitors, accountants, real estate agents.
Yes. So it's a risk management piece.
It keeps assets out of harm's way. The other reason is obviously if you're going to hang on to the property longer term but you're looking at switching out of the trust because of these new provisions, it doesn't come cheaply. You're putting the pin on duty,
right?
Settlement costs, and you are crystallising a tax event midstream. So you're going to be paying your tax on your gain to the date that you switch it over to your personal name. So from a litigation and risk management and asset protection point of view, absolutely. Those costs aligned with the loss of asset protection, there's not many cases that we're going to say, it's apt to move.
In terms of the 30%, in a practical world, how many commercial property investors is this going to impact?
It's a good question,
yeah.
And that's why we'll discuss it later on. We don't see that trusts are actually spoiled.
Right.
We take the view that where the 30% tax on income coming out of a trust is detrimental to somebody is where they're living in lower tax thresholds. Generally, people using trusts aren't in the lower tax thresholds, and they are paying normally more than 30% tax at any rate. So, it's not going to make any difference to them because they're already paying 30 cents.
And finally, how should investors approach their structures for new commercial acquisitions going forward? Is it still a trust, or should they perhaps look at something else now?
The second limb to the changes that went through was the changes to capital gains.
Yes. And
that impacts very strongly also on what we do with new acquisitions.
Yes.
Obviously, the trust income, if it being taxed at 30%, there's very few circumstances, I can't say categorically everyone, but there's very few times that we're going to find that the income impact at 30 cents is going to be negative for a trust. The bigger impact is on the capital gains. The capital gains are treated differently in a trust than the new income treatment. Capital gains flow straight out of the trust into the hands of the beneficiary. So they're not taxed at the trust level,
Yes.
like the new income rules. The capital gain is still taxed in the hands of the beneficiaries of the trust. And this is where the new capital gains rules come in. Thankfully, the capital gains 50% discount was grandfathered,
Yes.
and that'll be at the 30th of June 2027.
Yes.
And folk who are hanging on to their properties will need to do a valuation. That valuation will be the closing valuation for the assessment of the grandfathered 50% discount. That valuation will then form the base for the new CPI indexing. So your capital gain assessment or calculation will be two-tiered.
Yes.
One, your first holding period up to 30th of June 27, 50% discount.
Yeah.
Then from 1 July 27 onwards, taxed under the new CPI indexing methodology. It's very rare that that's going to cause, it will impact. In some cases, it's surprising there won't be a negative impact. We've run a few case studies that we've talked about. And in fact, it actually, depending on the circumstances, it's actually going to be cheaper under the new regime. Not significantly, but surprisingly, depending on the circumstances, it can be a better tax outcome.
Yeah.
We can't, given the asset protection, it's rare that we'd recommend an exposed person put assets in their own name. Trusts aren't going to give them any better position. In fact, the analysis we've made is that holding your property in a trust versus holding it in your own name, you're not going to get any different tax outcome.
Interesting. So we'll in future podcasts that we're going to release next week, we're actually going to run a live case study on various structures and what they mean in dollar terms. But Grant, thank you very much for joining us today.
My pleasure.
Guys, if you're like me, I need these things explained to me 3 times over before I've got a vague understanding. If you do have any questions about structuring up your next purchase or what this means, to your current asset, get it direct from Grant. Reach out to Grant. He's at UHY Haines Norton. They're located in West Perth. Thank you, Grant.
Thanks, Dave.